Okay, so good morning, everyone. Welcome to today's macro snapshot. We are Thursday, January the 30th, 2025. Okay, let's quickly review what's going on, what happened yesterday, a couple of different things here. So, I mean, basically, we had the Fed meeting yesterday. Nothing really emerged from that. Powell was sort of was questioned about Trump and said that they would remain politically independent. Trump, of course, tweeted and said that Jay Powell created the problem in the first place, and that he would have to take on the mantle of the you know slaying the dragon of inflation through increased energy production. We shall see. We'll talk about that in a second. But basically, the takeaways were that Powell still thinks that policy is in some measure restrictive, meaningfully restrictive. So I think that means that the possibility of hiking interest rates to become more restrictive is very, very low. We would have to get an extremely strong kind of exogenous event or situation to cause that. Powell also really wanted to be very clear in saying that they're kind of in a wait and see mode, waiting to see sort of is going to be any tariffs implemented, and also just general policy, and also just saying, listen, that's what the government does, the elected officials, and we will react. I mean, what they're doing in private is another issue, but that was his public stance. In terms of future interest rates, sort of path and things, Powell seems to be in a space where he's thinking that employment is pretty good. The economy in general is robust. And there still are some lingering concerns about inflation, although he did mention that owner-occupied rents are going down sort of over the medium term. So there was a little bit of hope there. So all in all, I think what we have to take away from that is that they're on hold, probably for several months. He did say they want, I think the word he used was serial series of data. So they need probably several months of consistently lower inflation before the first hike. So I think at this point, the market is pricing in. I think let's have a look here. I've got it here. The market is pricing in at this point. Let's have a quick look. Two cuts, I think, by the end of the year. So let's have a look here. Yeah. So, 1.95 cuts. So basically two cuts by the end of the year. I think that's probably about right. And we looked yesterday at the dot plot. That two cuts matches up approximately with the dot plot from the Fed, and that's what Powell's saying. So if inflation continues to drift down, a couple of percentage, a couple of tenths, probably we'll get a cut sometime in, who knows, maybe sort of April, May, June area in the middle of early summer, and then maybe one towards the back end of the year. So I think that's where the market is at the moment. Of course, we don't have any tariff information from Trump, which could or could not be inflationary. Geopolitical events, the real economy slowing down. So I think we're pretty much sort of the risks are pretty even at the moment. I think volatility will probably go down. So let's keep an eye on the MOVE index. In fact, let's have a quick look at that for bond volatility. So, excuse me. Actually, do I have that? Just a second, guys. I may have to just do something here. Stop share. So I've got a lot of things up on this computer here. Yeah, here we go. So if we look at the MOVE index, which is kind of the volatility of the general bond market, let's have a look. Pretty low, not at its all-time lows, down in the low 80s here, but still relatively low. And as long as the MOVE index keeps pretty low and bond yields remain in a sort of a stable range, I think ultimately in terms of the equity market, that's going to be a supportive for equities. Talking about equities, we see that the VIX index is low as well. So I think the takeaway from Powell yesterday is, almost like a business as usual scenario where he's saying, listen, I need a bit better data, excuse me, on inflation. Everything else seems to be okay in terms of the economy. No reason to cut, no reason to hike. Let's see what Trump has to do. And that's it. I think he sort of signaled that they're just in a wait and see mode. So I think what that's telling us is that, excuse me, sorry, it's very cold, so I have a dry throat. So I think what we're at a stage here is that central banking is taking a second seat to fiscal policy and politics. And there's a big deadline this weekend. I think it's the February the 1st is this Saturday, I believe. And that's the date where Trump has threatened, possibly to impose tariffs on Canada and Mexico and maybe even Europe and maybe even China. And I think that's going to be actually very, very important because if the market opens on Sunday night and sort of Monday morning, and no tariffs have been placed, I think that's going to really release a little bit of a risk-on kind of sentiment. It's always going to be a grey cloud kind of hovering in the background, but I think the market will take from that, if Trump doesn't put any tariffs on, that his bark is worse than his bite, or that it's indeed a case of the boy crying wolf in the forest. So we shall see. Probably my best case scenario, my best guess, to be honest, I'm actually going to be surprised if Powell slaps on 25% tariffs on, let's say, Mexico and Canada. Just because that would be pretty dramatic. And what we're seeing, reading between the lines, is that members of his cabinet seem to be arguing for a more gradualist approach, maybe, 2.5%, 5%, which can be ramped up as a pressure tactic. We shall see. One thing I did note yesterday was that during the confirmation hearings for the potential new Secretary of Commerce, I forget his exact name, it begins with El Lutek or something like that. Anyway, Mr. Lutek said that he said that if Canada and Mexico have more control on the borders and immigration and reduce the flow of the drug fentanyl, then there'd be no reason for the most punitive tariffs. So that's kind of interesting that he would publicly say that, all they need to do is to fulfill those conditions, and probably there wouldn't be, extremely heavy, the most heavy sort of punitive taxes. Interesting. What's also interesting is that on that headline, we saw that oil, WTI oil, actually came off 50 ticks or so. And that's just something interesting to note, the reaction function of oil to tariffs. And the idea here is that if there weren't going to be any tariffs imposed on Canadian oil, which is heavily imported into the US, that means that the US oil wouldn't be as expensive, so it would be cheaper. So interesting little sort of subplot going on there. So in terms of other stuff, what we saw, we had Tesla, Microsoft, and Meta reporting after the bell. They all looked relatively solid, nothing spectacular, but certainly no disasters. There was quite a lot of upbeat commentary. I think Meta was pretty upbeat on AI. Microsoft as well. We can actually maybe just have a quick look at some of those stocks just to see how they're going. So here's an hourly chart. So let's just put on Meta, just see how they're going, just see how they're performing. Oops, Vita Meta, VIX Meta. The VIX Meta, that's probably a good idea. The volatility of, here we go. So let's just have a look in the pre-market here. So we see was trading at 6. Okay, so up about $20 in the pre-market for Meta. So looking, relatively solid. If we look at Microsoft here, we can see that Microsoft is actually trading down a little bit. So trading down about 20. So there's a mixed bag, Microsoft down. We can also just see Tesla. I looked at the earnings when they came out. They looked quite, the forward guidance was relatively positive. So up a little bit. Okay, so we have Meta up a little bit, we have Tesla up a little bit, and we have Microsoft down, looks like about 5% or so. So that's going to be interesting to see how they trade today. A mixed bag. Of course, keep your eye on NVIDIA, which traded very heavily yesterday. So I think really the big loser in this, as we've discussed earlier in the week, is going to be NVIDIA and some of those AI data centers. But also just keeping an eye on the earnings. We have Apple. We have Apple coming out this afternoon, so that's going to be interesting as well. Okay, I just want to have a quick look, guys. We have the ECB coming up in about an hour or so. Now, let's just sort of see what's going on here. So if we just look at what's priced in for today. So we see here, this is the pricing for today. As you guys can see, exactly one cut priced in, or 25 basis points. So no surprise there. What's going to be interesting is really going to be the forward guidance. And we'll talk about the European situation in a second. I've got a couple of charts I pulled out. So we're seeing here that by the end of the year, the market's still expecting 3.8 cuts. So almost 4 cuts, so another 100 basis points of cuts. So pretty significant cutting cycle. And we can see that that's changed, just to see how that's changed a little bit over the years. So you can see that if we go back to the end of December, the market was pricing in about 4.6 cuts. And it's gone down a little bit. So it's gone down about, what's that, about sort of half a cut or so. So the market's priced in a little bit more, I don't want to say hawkishly, but a little less dovishly over by the way, this number here refers to the number of cuts. That's what that refers to. So 4 here means 4 times 25 basis point cuts for 100 basis points. So in terms of Europe, let's have a look and think what's going on here. Europe's the ECB's mandate, of course, technically is not dual like the Fed. The Fed's mandate is for full employment and price stability, whereas the ECB, of course, in theory, is only for inflation. But we know it's a very political beast, and we know that the ECB has a lot of well, it's just a lot of politics because there are many, many nations, and it's always balancing the weaker nations with the stronger nations, the more indebted nations with the less indebted nations. And it's kind of interesting. I just pulled up this little sort of series of graphs here from actually, it was something I came across, Bob Elliott, a macro commentator who I find quite interesting. I'm not saying I agree with everything, but it's interesting to look at his kind of summary here of his overview of the European situation, which is a nice way of framing things. And we can see here that he's basically saying that, okay, so inflation's come down, core inflation and the headline number here. But as you guys can see, it's still relatively high. It's still about around about sort of 3% for the overall number, and not at all at 2%, which of course is their target. And this is a central bank whose sole function is to target 2%. So bottom line, they're above target, still very much above target. And he makes the point here that a lot of that is services. So really the problem here is the services, which is this gray line. So you see the gray line here is about 4%. So significantly higher than just the overall core inflation, the blue. So we have this problem that services is very high. And then he goes on to say, well, okay, why is this? And one of the main reasons he's saying is that the wage growth is still pretty robust. So you see here that the wage growth here is still around about 4%. So this is an economy where the service sector is doing well. There's quite significant inflation in the service sector, tourism and everything. And wage growth continues to be putting upward pressure on that. So there's still sort of an inflation issue of sticky inflation, especially in the service sector. And he's also going on to say that where we got here, the unemployment rate for Europe is actually still pretty good. Now, Europe historically has always been, 7, 8, 9, 10%, as you can see here, a little bit higher than countries like, let's say, like Australia or the US, these kind of countries. But in terms of the European context, we can see that unemployment rate, I mean, obviously COVID went up to 8, 9% here, but you can see now the unemployment rate has gone down a lot, has reduced, and is actually pretty good. So we have a pretty strong labor market, which is causing, especially in the service sector, some upward pressure on wages. So the question is, the ECB is supposed to be cutting today, and as we just saw, the cutting cycle is pricing in about 3.5 cuts until the end of the year, much more aggressive, dovishly than the Fed. So why is that? And you also see here that just in terms of the inflation story, I mean, this is just one metric we can look at, is that, for example, the European gas contracts here, they had come down, obviously, with the Ukraine invasion of Russia in 2022. Gas prices absolutely went parabolic, but of course they've come down since then. But the point we can note here is that energy prices are creeping back up quite significantly in the Eurozone. So again, this is another factor putting a little bit of upward pressure potentially on inflation. So again, this question is, well, okay, so wages are a bit sticky, inflation is sticky, especially service inflation, and energy is going up. So why would they be cutting? And the answer has to be, oh my God, their economy must be collapsing. And we have been seeing quite a lot of headlines, but when we actually look at it, this is for the whole Euro area in terms of the GDP growth rate. Now, it's not great. We know in the US, it's like, 2.5, 3%. So certainly this is not powerful, but we're also not in sort of some kind of depression or negative growth rates. And actually, as you guys can see, over the last few quarters, it's actually been pushing up a little bit. So it's modest, but we can't argue that the Eurozone as a whole is declining in that sense. So therefore, the question really is, well, okay, what's going on? And what we can also see is that the stock market is actually up quite a lot. Now, to be honest, this stock market is dependent on global growth stories as well. But the point is that we have, about 1% GDP growth across the Eurozone. We have the stock market, which is doing quite well. We have a strong employment market. This is not economically a zone in collapse, I guess we could take away. But where we do see some weakness is actually in Germany. And you can see here that in contrast to the whole of Europe as a whole, Germany actually is negative and is weak. And maybe this is really what's got the ECB's attention. But of course, the question sort of is, well, is the ECB in the business of just supporting Germany and let's say France, or is it in the business of doing what's right for the overall economy? Because we have here kind of a clash is that the ECB, if they continue to cut too aggressively, and we can see what's priced in here in the implied interest rates, as you see, is going down, about another 7,500 basis points. So it's going to be quite interesting here is that if inflation is sticky, especially in services, and the ECB and the economy is relatively strong, why is the ECB cutting and not combating inflation? But it seems to be putting much more weight on trying to prop up some of the countries, for example, Germany, even though other countries are doing relatively well. So it's kind of an interesting one. And we might get the situation where we see that the ECB continues to cut and inflation actually remains quite sticky in going forward. Or on the other hand, maybe, for example, the ECB is right to be focusing on countries like Germany and say, hey, some countries are doing okay, but Germany is the historic industrial powerhouse. If Germany is not doing good or not doing well, we need to, proactively kind of cut relatively aggressively and have a pretty loose and dovish monetary policy, and we'll maybe let inflation, remain a little bit sticky. Interesting situation. So just in terms of the markets, I mean, what that's saying from a big macro point is probably that, things like gold, at least priced in euros, is probably going to do relatively well. The stock market, as we saw, real assets is going to probably do pretty well, especially against bonds. So bonds, in theory, could remain under a little bit of pressure if that inflation, especially the long end, remains sticky. And of course, something like the euro, we can imagine that we're going to have a weaker currency. So we can imagine that the euro, in theory at least, with not great growth and relatively sticky inflation and low interest rates, we have to assume that the euro will remain under pressure, especially against kind of stronger currencies, like let's say, for example, the US dollar, and maybe even something like the UK, which is going through a little bit of pain, but is trying to become clean up its business a little bit. So let's have a quick look at a couple of those. Just look at the euro, for example, we just talked about. So the dollar index down a little bit today. I'm not going to read too much into that. I think really everyone's just waiting for Trump, see what's happening with tariffs. And of course, we have some data today. But if we just look at where are we? The euro, where's my euro? Here we go. So if we look at the euro, again, we see that at the 50-day moving average, found it, sorry, that's my bad, as they say here. Let's put on the daily chart. Sorry, guys, that was the hourly chart. Yeah, but as you say, it just poked above the 50-day moving average in the box here, finding it hard, and now under a little bit of pressure. I think we'll see what happens with the forward guidance of the ECB today. See what they have to say. If they are negative about future growth, cut and signal that basically they definitely are on a pretty strong sort of cutting cycle and that they are worried about growth, I think we could see the euro come off. On the other hand, if they say, hey, growth is okay, we are still quite concerned about inflation, we're not on a predetermined path, maybe there could be a little bit of stability. But ultimately, this is going to depend on the US dollar, of course. Let's just see actually what's expected for the Eurozone. I forgot to show you, I have quite a nice graphic here, which I always like to dig out from ING, the Dutch bank. They have kind of like a bit of a cheat sheet here, which I always find useful as a summary. Here's their base case, which is for moderately dovish. So they're saying inflation outlook, overlooking the sticky inflation of the past month. So their view is that the ECB will kind of, sort of put that sticky service inflation a little bit over the side and say, hey, it's, medium term, it's coming down, expecting 2% this year. In terms of the growth, unchanged, balance of risk for growth remains tilted to the downside. In simple English, saying that means that they're a little worried that growth could actually remain a little bit depressed. Interest rates to cut 25 basis points and a little bit dovish in the trend. And, of course, Lagarde in her normal dry as dust style will no doubt say, data dependent. So keep in mind what would be sort of neutral or hawkish would be, basically saying that the growth is looking sort of okay, and there's a bit more of a worry about inflation, et cetera, et cetera. And here are some potential targets there. If you want to do a screenshot, maybe have a look at that. It's quite interesting. Okay, guys, just finally, what I just want to look at is just the data which we have coming up this morning in the US. We have GDP first reading for Q4, I believe we are. So if we look here, yeah, so we have the advanced reading for the fourth quarter. So this is slightly back backward-looking data. But what we're interested to know here is, is the US economy, that narrative of still being very strong and chugging along nicely. Expected, actually, annualized 2.6 rather than 3.1, so a slightly lower number seems to be expected here. Personal consumption down a little bit. What's this one here? The price index up. Okay, so a little bit growth down, price index up. Then, of course, we have the initial jobless claims. Again, that's been very, very strong for, I don't know, 3 years. So let's not read too much into that. I mean, anything, around like 200, 210, 220, 225, 230 is absolutely fine. And from a historical perspective, very, 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 very low. So that's what we're looking at there. Of course, the other thing to keep an eye out for today, as I mentioned earlier, we've got the Apple earnings. And the other thing I just want to have a quick look at here, I'm not going to look at bonds because they're very stable, not too much reaction yesterday. I just want to look at the oil chart here because we took a little position on oil, which I think the oil market is balanced. That's my personal view here. So if we look at oil, kind of interesting that oil had a big 61.8, the big fib retracement here from this sort of impulse lower here, horizontal support line here. There's a big down channel. We're looking for this to break out and maybe sort of retest back into at least like a Fibonacci retracement, maybe into, $76, $77, something like that. It's having a bit of problem, but it did reject lower this morning and bounced up. And my reasoning here is that the oil market, there's reasons to be a bit bullish. There's reasons to be a little bit more cautious. So I think it's going to trade technically within this range. It kind of broke out of this range, retested the high here. It's retesting the top of this range. I think we'd need something relatively significant to go back down in here. What could be relatively significant? Well, the first thing, as we saw, would be definitively no tariffs. I think that would cause some short-term negativity. If Trump did not impose tariffs on Canadian oil, that would mean that the oil coming in into the US would be not more expensive at the margin. But again, that sort of was discounted a little bit yesterday and was subsequently had a bit of a bounce back. Of course, if OPEC decides to increase their production significantly, I think that could be a negative for oil. But my point here is that oil has come off, what's that, $6 or $8 since the high here. Where are we? Yeah, about 800 ticks or $8. So I think this represents an interesting risk reward opportunity. Anyway, that's our view on it there. Okay, guys, we'll leave it there. Let's see what the ECB does. If there's any shocks, we have the press conference, of course. Look for forward guidance and obviously GDP readings and initial jobless claims. Okay, thank you and have a great day.